We're not completely through with dealing with depreciation expense, but let's look ahead just a little bit since we've got a fairly simple situation or problem that we're dealing with here, an asset that has been depreciated for a part of 2017 and all of 2018. And let's see what happens when that asset is disposed of in 2018. So let's say it's sold for $96,500 cash on April 15, 2019. To record the sale, we first have to update that depreciation expense. To record it to the date on which it was sold, and of course to update the accumulated depreciation account as well. A gain or loss is going to result whenever a fixed asset is sold for more, in the case of a gain, more than its net book value, or a loss is going to be recorded when the asset is sold at less than its net book value. The first thing we have to do is to figure out what net book value is, and so the entry to update depreciation expense is going to be this: to debit depreciation expense, $9,333, credit accumulated depreciation equipment for $9,333. And as you can see, what that is taking that, one way of calculating that is to take the $28,000 annual depreciation expense and figure out what portion of a year, for what portion of a year we actually operated it prior to the sale, and the answer to that's 3.5 months, 3.5 over 12 times the $28,000 gives us the amount of depreciation for 2019. And so having made that entry, we've updated our accumulated depreciation equipment balance, and that balance now is $44,333. So when we sell this asset for $96,500 cash, we debit cash for $96,500. We're going to credit equipment for the $150,000, that's its recorded cost, as well as the accumulated depreciation equipment associated with that asset, $44,333. And you can see there that the difference, that is what it takes to balance that entry there, the plug figure, so to speak, is a debit of $9,167. And of course that then represents a loss on disposal of the equipment. We might call this loss on sale of equipment or something else, but disposal is a good generic term that would apply whether we simply retire the asset, take it out of service without selling it, or whether we sell it, or even whether we exchange it, as we'll see, is a possibility later on. So that $9,167 is a plug, and we lost $9,167 because we sold the asset for less than, or I should say $9,167 less than the net book value of the asset. Among accelerated depreciation methods, surely the most common expression of it would be the double declining balance method. Sometimes it's called the 200% declining balance method, because what we're doing really is taking the straight line rate for a particular asset, doubling that, and using that double declining balance rate, or that doubled rate, to apply to a declining balance. In so doing, what we're going to do is ignore salvage value, at least in calculating the depreciation rate, but we will make sure not to depreciate that asset below its salvage value. Well, let's look at this example here. We're going to produce a schedule for the asset costing $150,000 with an estimated life of 5 years, an estimated salvage value of $10,000. Given this information, the straight line depreciation rate for a 5-year asset would be 20%. And the double declining balance rate, that is double the straight line rate, would be 40%. Well, notice in the schedule here, we've got one column that shows the years, 5 years of the asset's life, double declining balance rate, 40%, and a depreciable base of $150,000. Now, the depreciable base under the straight line method is going to stay the same, but under the declining balance method, it is going to decline each period. Well, let's figure the depreciation in the first year. Depreciation expense is found by taking the double declining balance rate, multiplying it by the base, and there you have depreciation expense for that first year. 40% of $150,000 is $60,000. Well, that's the first year of the asset's life, and so that's also the accumulated depreciation as of the end of the first year. Assuming it's a full year, by the way. We're going to simplify it in this sense and deal with other twists and turns later. So the net book value of the asset, that by definition is the cost less the accumulated depreciation, is $90,000. And that's important because that represents the depreciable base for the second year. And so that depreciable base of $90,000 times that 40% gives us depreciation expense in the second full year of $36,000. And accumulated depreciation then of $96,000. $60,000 balance at the end of the prior year, plus the depreciation for the current year, $96,000. And net book value, again, original cost less accumulated depreciation, is $54,000. Well, let's continue this. In the next year, you can see the depreciation is declining because the balance itself is declining. So the rate stays the same, but the balance to which that rate is applied is declining. So the depreciation expense is decreasing period by period. So at the end of the third year, we have net book value of $32,400, and continuing that, $19,440 at the end of the fourth year, and then finally, $11,664. It's getting hard for me to see from this distance. At the end of the fifth year. Well, something you probably noticed there, and that is that asset's not fully depreciated. It's kind of interesting because if you continue to apply that 40% forever, you will never eliminate the net book value on that asset. You're simply applying the same percentage to a smaller and smaller and smaller amount, but it will never get to zero, but it'll get mighty close to that. Well, anyway, we're not anywhere close to zero here. But notice this asset is not depreciated down to $10,000, which is the salvage value. Now, how will a company handle this in a given situation? Well, it could very well just take this last year here and go ahead and depreciate it for $9,440 here, which would end up providing accumulated depreciation of what, $140,000 and a net book value of $10,000, which represents the salvage value at the end of its estimated useful life. That's one way to handle it. We'll look in class at another way that companies generally handle that, and that's by switching over from double declining balance to straight line depreciation at some point during the life of the asset. But I'll wait, we'll hold that explanation until time when we've got a little more opportunity to maybe ask questions. Here are a few other issues that we need to address. At least I want to introduce those to you, and then in class we can get into some more of the details of these things. Leasehold improvements. That is where you've got a leased property, but you actually make some physical improvements yourself to make the property useful for your own purposes, whereas the lease might even represent a rental agreement of some kind, or at least it's going to be handled or accounted for separately. If you've made these improvements, they would need to be capitalized and depreciated. Contractual rights and leasehold improvements are shown on the balance sheet at their original cost, offset directly by periodic amortization. Amortization is to certain types of intangible assets, or in this case, leasehold improvements, what depreciation is to physical or tangible assets. The amortization period, by the way, is going to be the lesser of the asset's estimated useful life or the lease term. That is, if you've got an asset that has an actually estimated useful life of 10 years, but you're going to be, this lease is only going to last for 8 years, then you're going to depreciate that asset typically over the life of the lease because you're going to be out from under that property. It's not going to be available to you after 8 years. Goodwill. Goodwill is an interesting type of asset. It's actually an intangible asset. It doesn't represent what a lot of people think it does. It doesn't mean just warm fuzzies or the benefits of a good reputation in the community or anything. Goodwill, in an accounting sense, has a very express meaning. It's the excess of the price paid over the fair market value of an acquired company. In other words, when you buy a going concern, you're probably going to be paying more than the values of the individual assets. And so if you do pay more for that, you would assign to the assets their market values, and goodwill would be debited for the excess over those market values. Goodwill is not amortized for accounting purposes, but it's going to be written down That is, we're going to record a loss on it whenever the value is impaired. And goodwill, like most intangible assets, are going to be evaluated at least annually to determine if an impairment has occurred. Natural resources represent an interesting situation for us. Coal extraction industries like coal, oil, natural gas, other types of minerals, timber, those sorts of things, are shown on the balance sheet at the original cost, offset directly by periodic depletion. Depletion is to natural resources what depreciation is to physical or tangible long-lived assets. The original cost represents the cost of the right to drill plus any cost required to develop that is to actually be able to extract the natural resources. Property, plant, and equipment used to extract natural resources must be depreciated over its useful life, but sometimes the useful life of that kind of PP&E is tied directly or inextricably to the natural resource itself. For example, if a train track is built into a mine, the track is of no use once the mine closes. It's probably going to be the case that the train track is just left there. The same case is probably true of, say, an oil rig. There may be once the rig has run its course, now what's above ground may be extracted and used elsewhere, or at least salvaged. But what's underground, pipes and those sort of things, are typically just left. And so they have a physical existence. They represent equipment or buildings, and yet they would be depreciated, but typically they're not going to be or have a use outside that mine, and so they're going to be depreciated over the life of the mine. Conversely, a train that runs on the track can be relocated and used elsewhere, and as such it would likely be depreciated over the life of the train rather than the life of the mine. Same thing would go for equipment used in the oil rig above ground that could be taken out and used later or elsewhere or sold. First of all, let's figure out what the depletion rate is going to be. The depletion rate is the dollar amount per barrel for the oil, in this case, that we extract. So we've got $100 million to buy the rights to drill, $400 million to actually develop or drill and create the structures to be able to extract the oil, minus $50 million, the expected salvage value of that equipment when we're finished, divided by the 90 million barrels of oil estimated in this reserve, and that gives us a nice even $5 per barrel. Well, next we need to record the cost transferred to inventory, and that's what we've got to be careful about. We don't have an expense until we actually, in this case, until we actually sell that inventory. Then we can figure the actual cost of the depletion. So first of all, we determine the depletion rate, as we've done, and now record the cost transferred to inventory. Well, if we actually extracted 2.4 million barrels of oil times the $5 per barrel, then we transferred to inventory $12 million. We reduce the oil well by $12 million. That's what represents the depletion, what we've extracted from this oil well. Now, we could use an accumulated depletion account. They're sometimes used, but it seems more common that companies actually credit the asset account itself rather than a related contra asset account. Notice what happens then. That means that we have taken out of the ground inventory that cost us $5 per barrel, $12 million for the 2.4 million barrels. But we only sold $2 million of that. So now we show the depletion expense of $10 million, 2 million barrels times the 2 million barrels times the $5 per barrel. $10 million represent the depletion expense, and notice we relieve inventory for that amount. So we've actually still got at the end of the year $2 million of inventory of oil that we've extracted from the well and shown have reduced the cost of that well, but yet haven't been sold.